Your rent is up, your paycheck buys less. But somewhere on Wall Street, an AI just made money predicting you'd miss a credit card payment before you even thought about it. I'm Thomas Paul. This is the comment section, and today we're talking about the new shadow central banker that never runs for office, never sleeps, and quietly front-runs your wages, your rent, and your retirement. Here's where things get interesting. Right now, most of us feel the squeeze. Groceries up, housing insane, markets swinging like a mood ring on Twitter, and yet big banks and hedge funds are posting record profits again. So here's the core question. Is AI the new tool the elite are using to lock in those gains by getting in front of your financial life? Picture this. An AI model plugged into your bank app, your card spending, your location data. It sees your balance dip, your hours cut, your DoorDash orders spike. That same kind of model is already running in trading desks that can dump or buy your 401k holdings in microseconds based on those signals. But it's even getting worse. Governments are in on this too. Central banks and regulators are starting to lean on opaque AI models to judge risk in the system. That sounds efficient. Until you realize no one elected the people who built those models, and even the regulators often don't fully understand how they work. So, let's follow the money. Who's building this stuff? Which banks are wiring it in? What are regulators actually doing about it? And what does this mean for you in the next 12 to 24 months? First, AI is already baked into the markets like sugar in a cake. You can't see it, but it's everywhere. Today, the majority of trades in big stock and futures markets are executed by algorithms, not humans. In some markets, well over half of all orders are placed and canceled by machines in milliseconds. High-frequency traders live in that world, fighting for a microsecond edge because whoever reacts first to news or data wins. And here's where things take a step further. Banks use AI to decide if you're creditworthy. That means feeding in your payment history, income, zip code, sometimes even device data, into black box models. Hedge funds are spending billions a year on AI, hoovering up alternative data, credit card receipts, shipping logs, satellite images of parking lots, geolocation pings from your phone, and social media sentiment. They're not guessing how the economy feels. They're watching you shop at Target in real time and trading based on that. When you and I log in after work and buy a few index fund shares, we're basically walking into a casino where the roulette wheel is controlled by people who saw all the bets 10 seconds ago. But then the unbelievable thing happened. We're not just talking finance bros in hoodies. The same big AI labs you hear about in the news are now welded to Wall Street and corporate finance. OpenAI has massive cloud and licensing deals that position its models as core infrastructure for banks and trading firms. Anthropic has multi-billion-dollar partnerships with cloud giants who count the biggest financial institutions as top customers. Google's DeepMind division has whole teams focused on using AI for portfolio optimization, risk modeling, and market forecasting. Training these frontier models is insanely expensive. We're talking token budgets and compute bills so huge that even big tech CFOs flinch. When you're burning that kind of money, your first priority is not, let's help workers negotiate better wages. It's, who can pay us 8 figures a year for this? Answer, banks, hedge funds, insurers, and security agencies. Here's where things get interesting. If you read how investors talk about this, they literally frame AI as the next critical financial infrastructure, like exchanges or payment rails. Not a fun chatbot. The new nervous system of capital. Now layer politics on top. Central bankers and regulators are finally waking up to the risks. You'll hear speeches from Federal Reserve and Treasury officials warning that AI can create new forms of herding, flash crashes, and systemic risk. The SEC chair has been blunt that AI can supercharge conflicts of interest. The same firm advising you could also use AI to profit from predicting how you'll behave. But when you look at what actually gets done, the pattern is, we're concerned, and we'll work with industry on best practices. Translation: a lot of self-regulation and consulting firm PDFs, not hard rules with teeth. But it's even getting worse. Meanwhile, assets under AI-driven strategies have climbed into the trillions globally when you add up quant funds, robo-advisors, and algorithmic risk systems at big banks. Enforcement actions that mention algorithms are still a tiny fraction of the market. On the other side, left and progressive critics are saying this is upside down. They're pushing for public AI models, bans on AI in areas like credit scoring and welfare policing, and democratic control over the code that decides who gets housing or medical care. Because right now, we've basically privatized the brain of the financial system. So what does this look like in real life, not just policy papers? Let's hit a few punchy case studies. Case 1, prediction markets and insider trading around big sports events. We've already seen scandals where accounts with inside knowledge of playbooks or game plans used AI-driven odds models to place huge bets on events like the Super Bowl. The markets moved sharply as smart money piled in, and regular bettors were left holding the bag when the truth came out. Who won? Insiders with data and models. Who lost? Everyone else providing liquidity, thinking they were just having fun gambling on football. And here's where things take a step further. Case 2. AI for landlords. Large landlords and private equity firms now use rent-setting software that looks at vacancies, neighborhood data, competitor listings, and demand to nudge rents higher in sync. When multiple big owners in a city use similar tools, the system quietly learns that pushing rent up $50 or $100 doesn't spike vacancies. So it keeps going. Winners, landlords and the software vendors. Losers, tenants, especially those with no bargaining power, priced out in bulk. Case 3, algorithmic traders scraping news about layoffs or interest rate decisions. The second, a press release hit saying a company is cutting 10% of staff. AI models read it, interpret it, and trade the stock before a human can even click the article. You'll see volume spike and prices jump or crash in seconds. One neutral analyst described this as a race to compress price discovery into the limits of physics. Sounds cool until you remember those price moves hit your retirement account while you're still at work, not even aware your employer announced cuts. But then he said this unbelievable thing. So how does this hit you over the next 12 to 24 months? First, volatility. When machines dominate flows, small bits of news can cause big swings. Your 401k or pension balance can whipsaw faster, even if you're invested in boring index funds. Second, inequality in credit and insurance. AI models can widen the gap between people judged safe and everyone else. Some studies already find that data-driven cost-cutting and automation are behind a rising share of corporate restructuring plans. In finance alone, hundreds of thousands of roles are at risk over the coming years as back-office and even some front-office jobs get automated. Third, layoffs and offshoring. AI lets executives model cost-cutting in real time. They can simulate what happens if they move a department overseas, replace half of it with software, or slash benefits. And they can do it faster, with enough plausible deniability to blame market conditions. Here's where things get interesting. Now, I'm not here to sell you fear or some magic escape hatch. Remember, in my early 30s, I ignored the hype and put money into boring, unsexy investments. It didn't make me rich overnight, it just worked slowly. That's why I don't trust anyone promising a once-in-a-lifetime AI trade that will save you from this system. So what can you actually do? 1. Diversify. Don't YOLO your entire future on whatever AI stock or crypto is trending. Broad funds, long-time horizons, and not panicking when the bots swing the market are still boring but powerful. 2. Avoid predatory fintech. If an app uses AI to offer instant loans with opaque terms or pushes you into risky trading with gamified dopamine hits, that's a red flag. The AI there is not your friend. It's optimizing how much it can extract from you. 3. Collective action. Support unions that are bargaining over how AI is deployed at work. Back campaigns pushing for public and cooperative AI models, strict rules on AI in credit, housing, and welfare, and real transparency from banks and funds about how their models treat people. But then the unbelievable thing happened. Quick pause. If you're watching this thinking, I'd love to run a channel that actually explains this stuff, but I don't want to be on camera. This whole video was built using Fludge.io. The same system that powers this channel. It researches topics, writes scripts, creates avatars and thumbnails, and uploads to YouTube automatically, while still letting you stay in control and jump in anywhere in the process. If that sounds like your lane, check out fludge.io after this. All right, zooming out. We've got to stop talking about AI like it's sci-fi robots and start talking about it like plumbing. This is code that decides who gets water and who doesn't when the pipe gets narrow. In a world where the pie is shrinking for most people, AI is being wired in to decide who eats first. That doesn't have to be inevitable. We can demand that banks and funds disclose where and how they use AI. We can push our representatives to ban or sharply limit AI for credit scoring, rent setting, and welfare policing. We can fund and build public or cooperative AI projects that serve workers and communities, not just billionaires. So I want to hear from you. Have algorithms already messed with your job, your credit score, your housing application? Drop your story in the comments. I'm planning a future episode where we dig into one of those stories in depth and trace the system behind it. This is the comment section with Thomas Paul. If you found this useful, hit subscribe, share this with one friend who thinks the game is rigged, and I'll see you in the next one. Quick disclaimer before we go. Nothing in this video is financial, legal, or investment advice. It's for education and commentary only. Always do your own research and talk to a qualified professional before making big money decisions.